Hello, everyone. We have decided to put another recording together. Joe and myself recently recorded something on the new stimulus package, and now we've been getting a lot of questions about the potential Biden tax proposal. And so, what I thought would be a good idea was to bring together the two tax experts here at our firm, Premier Wealth Advisors, to talk through kind of what's being proposed in Biden's tax plan. And I think it becomes even more important to discuss this, knowing now that um, the Democratic Party won the two seats in Georgia, the two Senate seats, and so they now effectively have a majority with the vice president's vote. And so, what the questions that are being asked to us are: what's going to happen tax-wise? Is there going to be significant legislation that comes out that's going to impact our clients? And so I figured let's get us together and start talking through this and see what we might be thinking is coming down the road. So welcome Ari Crandall, managing partner, and Joe LeBlanc, managing partner at Premier Wealth Advisors, along with myself. And both of these fellows are also enrolled agents with a lot of tax background. So let's talk through this, guys. And I think the one thing that seems to be the theme around most of the conversation around this tax proposal is that those with $400,000 of income or greater are most likely to be impacted.
So before we jump in, I just want to make it very clear. This is proposed tax law. It is not law yet. It will change from what we're going to talk about. But what we're going to be going over is what is going to be going to Congress and so forth to get past this legislation. Until it is inked and signed, this is all proposals, and all this information that we're going over is subject to change and adjustment and so forth. So I think it's really important to know that.
Right. And it's even important to recognize that a lot of this is from the campaign, proposals. And a lot of times those campaign proposals don't even make it to the legislative process. They're just designed to, provide a platform to get elected, but do not necessarily come into fruition at all. So that could be part of the case as well.
Yeah. Very good point. And I would say, make sure that, you take, this is not tax advice, and that you check with your own tax preparer before making any decisions or planning around what we're going to discuss today.
I always say, call us before you make any big decisions, because we might have some information you might not be aware of, right? And we've done this at least a few times before. So $400,000. So that is really the kind of the overriding theme on this tax proposal. Is if you make $400,000 or less of taxable income, you're not going to be impacted, right?
As much,
right? And most of the things we're going to go over today are going to kind of affect folks that are over that amount, primarily with tax bracket changes and reduction in write-offs and things like that. So right now, the top tax bracket, I think, Joe, it's 37%, right?
Correct.
Yep. And then so one of the main proposals right off the bat is to bump the 37% top tier tax bracket to 39.6%, which is what it was prior to Trump's tax law change under Obama. It was 39.6 for that upper bracket. All the other brackets are proposed to stay the same for individuals, right? So there's going to be no changes in those brackets. So when we hear, hey, the tax brackets are going up, it's only that top bracket going from 37 to 39.6 at face value. And I think, when you look historically at tax law changes, they don't always change the brackets, a huge amount. What they end up doing is affecting your ability to take deductions and credits and so forth, which we'll get into in a little bit.
Yeah, and I think that that's something that has been well known for quite some time, that this was part of the proposal, is bumping that 37 up to 39.6. And so I think that part is not a surprise. The long-term capital gains one, I think, is also one to point out, fellas, because I think, when we talk about the $400,000 level as being somebody that's going to be significantly impacted, but it even gets greater as you get even higher on the income scale. And so, there is some proposal around the $1 million level, specifics to long-term capital gains. So maybe touch on that.
Right. And this is kind of, it goes back to some things we heard in past years from Warren Buffett of, people that are in that, realm. Most of their income is coming from capital gains, dividends, things that are currently treated at a preferential tax rate. And, Warren Buffett is famously quoted as saying, he pays less tax as a percentage than his secretary. So this is one of those ways to correct part of that. And for people with AGIs greater than $1 million, their capital gains and dividends, that tax may go to ordinary tax brackets rather than the preferential rate currently under existing law, which is 10%, 15%, and 20% max. So you could see, Warren Buffett essentially doubling his income tax because he goes from a 20% bracket to a 39.6% bracket.
Right. And so right now, short-term cap gains are at ordinary income, right? Ordinary income tax rates, and that's if you've held a position for less than a year, right? You're going to pay ordinary income tax on those gains. And so this is effectively saying it doesn't matter how long you've held this position. If your income is over the threshold, it's considered ordinary income. You don't get that break in the tax rate between long-term capital gains and short-term capital gains. So this can be really interesting, especially for clients that are stock option holders or have restricted stock units, because they can teeter up and down on this scale depending on the year, on what year it is, right, and what they're doing with stock planning. Oftentimes we try to spread the tax out over multiple years, or spread those options, and those restricted stock unit sales over multiple years, and we're always balancing that between, well, what do you think the stock's going to do if it goes up or down? So, I mean, there could be some really deeper level planning that needs to happen around that. So, but like we said, until it's law, it's not. But it's good to know that it might be
right. But it definitely brings to the forefront the importance of that, tax loss harvesting and tax efficient investing, and investing and managing your assets in a way that you don't cause a lot of capital gains or you don't cause a lot of dividends that throw you over that threshold. And just to so people understand, it's not an on-off switch. So it's not like if you have $1,001, all of a sudden all your capital gains are taxed at the max rate. It's only the capital gains above $1 million that would be taxed at that rate. So if you were at $1,010,000, only that 10,000 difference would have the higher rate. You still are going to be below that.
Right.
Yeah. Good point, Joe.
Right. So,
and the other thing that I think it's important to point out is when the net investment income surtax is still going to apply here, right? So that's been a tax that was been in the code a little while now, which means that if you earn a certain level of income, and I think it is around that $400,000 level, or maybe even a little less than that, where you get an additional 3.8% tax. So if you think about the higher income folks today that have capital gains, they're maxed at maybe 23.8, right? With the 20%, which is the highest level of capital gains long term, plus that 3.8. Well, now that's potentially can go as high as almost 44% when you factor in the highest tax bracket plus that additional 3.8%. So it certainly can have a significant impact. I mean, we have situations where folks own real estate, or maybe they did have a big stock position like Ari mentioned, and then all of a sudden now that's going to be taxed at a much different level. And so there's certainly some planning aspects to it, something to be aware of. And the other part of it would be that if you have that situation, a lot of times people say, well, I got to wait till 12 months and a day to sell it because I'm going to get that better break. Well, you don't have that problem any longer in terms of having to wait. Not that that's a positive.
You don't erase it. You don't erase it because you still have some money that's going to be below that $1 million that's going to have the lower, preferential rates. It's just the amount above that. And as I said, so now we're looking at tax loss harvesting. So if you do have a huge gain that pushes you above $1 million, start looking at ways that you can create some losses or harvest some losses to bring down those highest brackets.
Unless your other income has you already above $1 million.
Right.
These are all good problems for most people, right? Let's keep it in perspective. But nonetheless, there's going to be folks that are going to be impacted. And it could be folks that have like these one-time events during the year. Like last year I had a client, he's normally well under the $400,000 line, but he got an offer he couldn't pass up on a home he owned, and he's going to have few $1 million on his tax return, right? And this could be one of the years where someone has like a 1-year event impact that could be substantial, right? So it's just good to be aware of these proposals.
So one other one that we're hearing a little bit about that I think is interesting is regarding the itemized deductions, right? And if you look back at the Tax Act that Trump put together in 2017, there was the higher standard deduction levels that meant that a lot of people ended up not even doing itemized deductions any longer. Well, now with this new tax proposal, there is potentially a cap being discussed on itemized deductions. Maybe you guys can cover that a moment.
Yeah, so there were two parts of the Tax Cuts and Jobs Act that addressed this. Part of it got rid of what was called the PEAS deduction, which was the itemized deduction phase out. And so as your income went out pre-Tax Cuts and Jobs Act, so 2017 and before, your amount of itemized deductions actually reduced. So there was a negative side, but you could have unlimited tax deduction for what was called SALT, state and local income taxes. So you had a much bigger deduction. And then again, offsetting that was AMT. So if you had too much deduction in that category, AMT could bite you. So Tax Cuts and Jobs Act cleaned a lot of that up. They got rid of that itemized deduction phase out, but put a cap of $10,000 for state and local income tax, which for a lot of people got rid of the AMT problem. And so, it actually solved some problems. And now we're talking about kind of going back into that territory where your itemized deductions will kind of phase out, but they're also talking about increasing that state and local income tax deduction from 10 to 20. So potentially that will help out some people.
Yeah,
especially high income tax states like the state of California. Of course,
Exactly.
That's where there's been a lot of complaints around, hey, you're in a high state income tax, California, New York, New Jersey, being majorly impacted. And so that could technically be a little bit of a benefit for those that live here.
What's interesting under the tax plan is the current tax plan is a lot of our clients ended up taking the standard deduction on the Fed, but they still itemized for California. And I just want to mention that because sometimes people say, oh, I don't need to keep track of my deductions anymore. I don't need to keep track of it, my property tax. But keep track of everything because state law does not conform to federal law. There are things that are deductible on the state that are not deductible on the Fed and vice versa. So it's really important to just, continue to have that record keeping. And, if these proposals go in place, still track your stuff, get through a tax year or two. And maybe you can narrow down the list of what you're keeping track of, but it's really important just to recognize that this is federal tax law, not state tax law that we're speaking about.
Correct. And states like California especially will pick and choose what parts of that proposal they want to adopt into their own tax law. But you're right, Ari. Right now, itemized deductions look very different for California than they do for the IRS.
Yeah. So, Josh, did we answer your question?
You did. I just want to make sure that because what I have heard in there is that I don't think you covered this though, is exactly what the cap in terms of a percentage is.
So yeah, that kind of a new proposal is, as your income goes up above 400,000, rather than taking a marginal deduction for your itemized deduction. So if you're in the 39.6% bracket, every dollar of deduction takes 39.6% of your tax away, to limit that deduction to 25 or 28%. So essentially, if you had $1,000 of deduction under the current rules, you're taking away $390 of income tax. Under the proposal, it would only take away $250 or $280 of income tax. So you'd still get that deduction, but the actual tax change would be less. So you maybe have 2/3 of the tax change compared to under current rules.
Yeah. So easy math. Let's say you're putting $10,000 into your 401k plan. It might be saving you, $3,900 in taxes if you're in that upper bracket, right? This would limit that tax savings down to $2,800 or $2,500. So this could be where there's some advanced planning that's done, and we take a look at, okay, does it make sense to put that in a pre-tax 401k? Is there a Roth 401k option? Weigh the pros and cons and determine, what path you want to go down or what combination you want to go down, because there could be some great planning opportunities that might be a little short-sighted today, but down the road can have huge benefits, depending on how all this shakes out. So definitely a good consult with your guy opportunity.
Yep. Yeah, exactly. And Ari, you've actually hit on a different point of the tax proposal. So that is a proposal to limit the deduction for your 401k contributions, but we're also talking about limiting the deduction for itemized deductions.
Yeah.
So both of those things seem to be in the proposal to limit the ability for really the high income taxpayers to get a full benefit from those itemized deductions or retirement plan contributions.
Yeah. So effectively, you could be in the 39% income tax bracket, but only be taking deductions at 28 or 25%, respectively. Right. So.
Right.
I think, and what that tells me is the theme remains that it's all consistent around that 400,000 and above. Really trying to hit those higher income level folks, and in terms of reducing the benefits of those deductions.
Right.
Another one that is right around that same theme that I think is probably the one that's most questionable, I think, for our three perspectives, is the Social Security tax potential increase. And what they're trying to look at there is above $400,000, bringing back the 6.2% Social Security tax, or 12.4 if you're self-employed, right, guys? And and so what that does, if you think about where we're currently at on Social Security, they tax that income up to about 137,000 today, and then now they're talking about, okay, well, let's tax also anything above 400. Is that how it's worded?
So the Social Security wage base, Josh, for 2021 is 142,800.
Okay.
Okay. So when you look at your W-2, there's boxes 1, 3, and 5, which show your wages, and there's boxes, the other boxes that show your income taxes withheld right next to them. And Social Security taxes equals 6.2% of your wages up to $142,800. That's what's coming out of your paycheck going into for Social Security taxes. And your employer pays the same amount. If you're self-employed, you get to pay both halves of that. And so the proposal is saying you get to that 142.8, any dollar above that, you stop paying that 6.2% until you get to 400K. And then once you go over 400K, you start paying 6.2% again on the amounts above 400K.
Right. And this is kind of mirroring the something Josh hit on a little bit earlier, the net investment income tax, or the Medicare surtax, which hits wages above 200K, an additional 1.9% or 3.8% on investment income. So, as your wages go up, you're getting more. Fortunately, this is one thing that cannot be done by budget reconciliation. So it would take 60 votes in the Senate to pass this particular provision to increase the Medicare, or the Social Security tax on incomes. So that,
which is why we think it's
less
unlikely.
likely to occur. Less likely to occur. But you never know. It could be part of a compromise agreement.
Yep.
Sure.
So once again, it's kind of like this waterfall effect that happens for folks that push above that income level. And oftentimes these tax law changes, they take away deductions and they have add-on taxes when you have certain events that happen above certain thresholds.
Right. And the funny part about most of these proposals is they're technically not new taxes. And so, they can go out and say, well, we didn't create any new taxes. We just increased the assessment of the current taxes.
Right.
Yep. All right, let's shift gears, fellas. For those folks that own appreciated assets, this is also one that I think we'd agree is probably a challenge, and that's the idea of eliminating the step up in basis of a capital asset upon your passing. And first, before you get into that, maybe one of you can describe what it means to step up in basis.
Sure. So give us a very simple example. Let's say you bought that, stock forever ago, or grandma bought the stock forever ago for $10 a share. And the day she passes away, you're going to inherit that stock and it's worth $100 a share. Okay, so there's been $90 of share price appreciation between the date she bought it and the day she passed away and you inherited it. Under current tax law, if that stock is sold by the inheritor after passing, the basis on that asset is the date of death value. So you paid $10 a share, it's worth $100 a share the day the person dies. You inherit it when it's worth $100 a share, and you sell it for $101 a share. You pay tax on $1 of price appreciation. Make sense? Okay. Under the proposal, your cost basis is $10 a share, what that person paid for it forever ago. Now,
well, actually, interestingly, there's a companion proposal, which is to make death a taxable event.
Right.
And so essentially you would get a step up in cost basis because grandma would pay the tax, or grandma's estate would pay the tax on that $90 per share. And you would get it at 100 per share, even if you didn't sell it.
I'd be hard pressed to see if that would.
Both provisions are, somewhat out there as far as tax law is concerned.
Yeah.
But
I just don't know how they're going to track. I just don't know how they're going to track it. Like, how are they ever going to track, what the stock basis is? I mean, we got clients that inherit homes that they've been in the family for 70, 80 years, right? And technically, there's cost basis, the purchase plot price plus improvements, et cetera, et cetera. Like, how do you prove one way or the other what the true cost basis is on some of those assets?
And that's why, from a mechanical perspective, making death a taxable event is actually an easier thing to do, because then you don't have to dig up those records of, well, when did grandma buy that AT&T stock, and oh, by the way, it's split 8 ways into all the baby bells, and now you own Verizon and Southern Bell and yada yada yada. Which stock do you really own? What was the price you really paid for those shares?
Right.
So
and
if
this
it's
has been a
just
problem.
taxable event, you're done.
This has been a problem prior to any of this stuff. I mean, we get clients all the time that come in with old stock that they had from given to them years and years and years ago, and obviously in a gifting situation, you're getting gifted that original cost basis, and they don't know what the heck it is. They've had it for years, and so the implementation of this particular one, I think everybody agrees, is going to be quite a challenge. So we'll see where it ultimately ends up. But it's out there. It's being proposed and considered. The other one that I think folks feel is much more likely to happen is the estate tax exemption being lowered. And so maybe we can talk about that, because I think that one has a lot more legs in terms of coming to fruition. And so maybe explain what that means from an estate tax standpoint.
So the estate tax exemption has been evolving, since the Bush era. Really, that was the first time that we had significant estate tax reform. Way back in the 80s and 90s, the estate tax exemption was $600,000, and then it went up to $1 million. Then it went away, and then it became $1.5 million and $2.5 and $3.5. And under Trump, under Obama, it went to $6 million, and then under Trump, it went to $11 million. So, we're really getting, fewer and fewer estates that were paying estate tax anyway. And talking like fractions of a percent of estates were paying estate tax, even at $6 million. But primarily it was for, farmers and people that were land rich or, asset rich, but cash poor. That estate tax really affected those people, because if the grandkids had to sell the farm to raise the estate tax, that was not a good event for the family. It might be for taxation purposes, but not for the family. And so we're now at currently round numbers $12 million estate tax exemption per person. So a couple could have a $24 million estate tax exemption, and under the Biden plan, we're ratcheting that back to maybe $3.5 to $5 million estate tax exemption per person. So it's still a big number. and still will only affect a small percent. It'll be less than 1% of estates will pay estate tax, but it is a rollback of the Trump tax cuts.
Yeah. One thing that's interesting about Biden's plan, just in general, outside of the estate tax thing, is the taxes are higher than the Trump plan, but they're lower than the prior Obama plan. Which
in some cases, yeah.
For a lot of the proposed things. So, it's just important to kind of put that in context when, because I've got, we always get a call or two when these things come through, and they're saying, "Oh my God, what am I going? I got to do something here. This stuff's going to ruin me." It's like, just slow down a minute. Let's take a look at what's proposed. Let's figure out what's going to be law, and let's put a little context around where we are and where we're going and how that's going to impact you.
And that's a big reason why we're putting this together today. Is there is a lot of fear whenever there's a change. Folks don't like change necessarily. Some do, but when you're changing to the point where people are fearful that it's going to impact them, then they go down that rabbit hole of, oh my gosh, what's going to happen? And so what we're hoping to accomplish with this discussion is just to kind of, like you said, Ari, put some perspective, kind of reduce a little bit of that fear that, hey, these numbers in terms of, if you less than 400,000, you probably have very little or minimal impact. As you get into these higher numbers, there's some pros and cons in some of these pieces. And then you get over $1 million, there's probably some big impact. And then it becomes a matter of how do we plan for that and start to really think through that. But, the estate tax exemption, like you said, Joe, has been evolving for our entire careers, it seems. And it's a constant moving target. Congress is always looking at it. Both sides are always looking at it. And I think that it's important to understand, what does it really mean when you have an exemption? Well, what you're saying there is, if it's let's just call it a $5 million exemption amount, that means that if you're an individual single person, you can have up to $5 million at the time you die and not pay any estate taxes. It's only
Correct.
the amount above that would ultimately be subject to that estate tax. And so today, as you said, it's almost 12. It's 11.5, almost $12 million. So it's a much bigger number, but still, there's very few estates that are going to be impacted by this. But we live in Southern California, and people do have a lot of wealth in their homes, and so there could be impact, to our clients that are, have those estates above the 3.5 or 5, and so it's something to at least be, understanding of.
Right.
And it would be interesting to see if either the step up in basis or the death as a taxable event go through, how that affects estate tax, because that's part of the current estate tax regime is that $5 million or whatever it is. If you are paying estate tax, you're not paying capital gains tax on the same money. So it could create essentially double taxation in some cases. So you might have capital gain tax and estate tax on some estates.
Good point.
Potential mess, right?
Yeah. But yeah, we're talking, the Zuckerbergs and the Winklevosses and
right.
the Bezos and those people.
Josh, have you heard about the first-time homebuyer credit proposals at all?
I've heard about them, and so maybe you can touch on that's potentially being reintroduced. So talk to that point.
Yeah, sure. So during the housing crisis, the government, put in emergency legislation, and one of those pieces of legislation was the first-time homebuyer credit. This is back in 07-08 era, or 08-09, excuse me. And there were two versions of that first-time homebuyer credit, and one of them was the first one was a $7,500 credit, and what that meant was if you purchased a home, there was $7,500 that would go towards paying your tax liability on your income tax return. Okay. And that home buyer and that credit had to be paid back at $500 a year until it was paid in full. So you got the money up front. It's basically a free loan from the government of $7,500 when you bought a home that you paid back $500 of tax return until it was paid off. And then the second version was just, here's a check for $8,000 for a first-time home buyer. And there was no capture back on it. And first-time home buyer meant you didn't own a home. I believe it was within the last 3 years or 5 years. I can't remember specifically. It's not first time ever. I think it's just, you haven't, if you, let's say they were foreclosed on and they were renting for 3 or 4 years, then they'd be considered a first time home buyer again.
Right.
So they have a new proposal with this plan, and it's a maximum of $15,000 for a home purchase. And so when I read a maximum of, there's probably some income thresholds that are going to be part of this legislation. That's going to determine, do you get the full 15,000, do you get a lesser amount or not, right? So we don't know specifically. And then it's potentially refundable and advanceable, which means that you can, in theory, it could be used prior to filing your tax return, probably go through escrow and help with the purchase on the home itself. So this is pretty exciting for folks that are on the bubble around affordability and so forth. Obviously, rates have been really low for quite a time now, and one of the surprises out of COVID was this housing boom that happened, and everyone was selling a home, buying a home, transitioning, whatever. And so house prices went up a lot this last year, and this potentially helps open the conversation for home ownership to a lot more people.
Yeah, which is great. I mean, you're right. It's been quite an increase in values across the country, and that's certainly had an affordability issue for a lot of folks that were on the bubble. So, that could be a good thing.
Yeah.
Speaking
if that goes through.
Yeah, right.
If
Once again, exactly. All proposed at this point. There are some discussions around child tax credits, child and dependent care credits that maybe, Joe, you can touch on in regards to what adjustments might be coming down the path for those.
So again, one of the positive Trump tax changes was to increase the child tax credit up to $2,000 per child and raise the phase out. Under the previous law, it was $1,000 per child tax credit, and the phase out started at about 100,000. So if you made more than 100,000, you started losing the child tax credit. Under the Tax Cuts and Jobs Act, they raised it to $2,000 per child, and the phase out didn't start till 400,000. So you had to have a much higher income before you started losing the child tax credit. Dependent care credit hadn't really changed. It was still a 20% credit on the first $3,000, or for one child, or up to 2 children, $6,000 total that you could spend and get a 20% deduction on, with no income limit. So that was, it was nice, but not great, and not the end all be all as far as what was going on in those two credits. And so the proposal does increase, or propose increasing those credits a little bit. And again, having that 400,000 phase out, so as your income goes up, you potentially get less credit, and people at relatively lower incomes get more of the credit.
So just to give a little context around the dollar amounts, the child tax credit is proposed to go from $2,000 to $3,000 under the plan, and that's a refundable credit. So, which means that, so a credit is an offset for taxes, your tax liability, right? So if you have a $2,000 tax bill and you have a $3,000 tax credit, right? You effectively would that would be an offset, and you would pay no tax. What's nice about refundable credits is that you can get the credit in excess of your tax liability, which means effectively the government is giving you money above and beyond your tax liability. So there's refundable credits and non-refundable credits. So the child tax credit is proposed to be a refundable credit, which means more money in your pocket if you don't have a tax liability, up to $3,000. The dependent care credit, right now, like Joe mentioned, 20% up to $3,000, $600 credit on your tax return, right? So that threshold's proposed to go all the way up to $8,000 of child care, subject to that threshold as well. So all proposed, but this is pretty exciting stuff, because this is really can be a significant impact for folks under that $400,000 threshold, right? And this is a transition of some more money and effectively mitigating taxes and helping lower effective tax rates for a lot of people. So
and these two credits definitely are targeted at relatively lower income, average families, not the, we just call them the dinks, the dual income, no kids.
Right.
So that this is, for the families.
Yeah.
Yes. And boy, do we know that families can use some help these days with all that's happening with COVID and
Yep.
No doubt.
homeschooling and everything else.
Yeah.
Yep.
One other credit just to be aware of that's, I think, a brand new when you talk about, no new tax laws. There is being proposed a caregiver credit for those who are informal long-term care caregivers in the household of
Okay.
potentially up to $5,000. So that's something just to be aware of that's out there as well. That's being talked about for those who are helping folks out in the home.
I did want to talk about a health insurance provision that's in this legislation as well. A health insurance cost provision that's in there. There is basically an assistance for health insurance access through the Biden plan, and this is again a refundable tax credit for health insurance premiums. And effectively, they want to try to limit your health insurance premium so that it does not exceed 8.5% of your income. All right. So if your AGI is, let's say, $100,000 and your health insurance premium is $8,500, that's 8.5%. So there's a credit that if you're paying more than that 8.5%, in premiums, there's going to be some reconciliation or a credit offered on the tax return. So still developing, but that's kind of nice to see, because I know that because of the whole COVID thing and people transitioning, losing jobs, starting a business, working from home, and all those different things, that this could potentially provide quite a bit of tax relief for a lot of people. So this is going out on their own, having to pay for health insurance and so forth. This is a huge benefit, no doubt.
Right. And interestingly, the premium tax credit, although Trump was able to get rid of the individual mandate, which was the penalty for not having health insurance, the premium tax credit still exists. So for
Right.
low income people, you can get federal and now state money to help pay your insurance premiums. So that is still in play. This is just kind of expanding on that for the people who don't fall into that category, because it was, I believe, 130% of the federal poverty level was that cutoff, where you had to be below that income limit to get the full premium tax credit. To now, throw some money into the game for people who are paying health insurance premiums but aren't, necessarily that lower income cohort.
Right. So,
And the question on it as well is what would qualify for that coverage. Would it be a bronze plan? Would it be a silver, gold? And probably not people that are on the platinum plans that have the best coverage and are paying for it. But there must be some middle ground.
Yeah, and
yet to be determined.
There's also a little provision in there that there's some increased tax benefit for long-term care insurance as well.
So, fellas, I would want to wrap up here pretty soon, but I want to just touch really briefly on, corporate taxes or business owners.
Sure.
I want to just mention on the corporate tax front, because when you think about corporate tax rates, you're thinking about how that impacts the overall economy, which then impacts every one of us, whether it's within our, stock funds and our 401ks or anything else. And so, the proposal on the corporate side in terms of what big businesses are going to be paying in taxes, the current rate is currently set at 21, right? Or is that what it is?
21%.
21.
And so they're talking about bumping that back up to 28. But prior to 2017, it was 35.
Yeah.
Right.
And so even if that happens, it's not going to be what it was prior to the Tax and Job Cut Act.
Right.
And so I think that's something to put into perspective as well, that I know there's a lot of concern out there. Oh my gosh, the corporate tax rates are going to sink the economy, and I don't think that's necessarily going to be the case. I just want people to be aware of that.
Yeah, and we're talking C corporations, which are large, generally publicly traded corporations. We're not talking mom and pop S corps.
Yeah.
We're talking the big corporations, and the funny part of that is a lot of the large corporations. Guess what? They're taking money on somewhere else, either through worker retention credits or with local agencies. dealing on, tax credits that they're getting from local agencies. When Amazon wants to build a distribution plant in your city, that they're not doing it out of the goodness of their heart. They're going to get, or they're going to negotiate between 6 or 7 different cities to get the best deal. So that could be less sales tax, less payroll taxes. There's something in it for Amazon besides being nice to build a plant in your hometown.
Usually, yep.
Yeah.
One thing that's interesting on the corporate tax rate too, speaking of the big corporations out there, there is also a minimum tax for corporate book income of 15% on the 100 million and higher of corporate book income. So that's another provision in there that might affect, obviously a lot of the larger publicly traded companies. But like we said, it's still less than it was under prior, under Obama administration, but higher than it was under Trump administration. So, which is kind of like,
right.
It's kind of the middle ground here is it seems to be a lot of Biden's provisions are sort of not what they were, but not as good as they've been from a tax perspective, and I will say, we do a lot of tax returns here, a lot, and we get a lot of transparency around how tax law changes folks' overall tax picture. And, just don't believe all the headlines that you read. I will say that a majority of folks under the last tax provisions had an overall reduction in total taxes. A majority of folks did. And I can, I can vouch for that. I did close to 400 returns that first year that tax law came through, and I'd say maybe about 85 to 90% of folks had less overall taxes that they paid. And so, we'll have the same perspective once this plan goes through and what provisions go through to see, are taxes going up? How many people are being impacted? What's the overall outtake? So we definitely have a lot of exposure, real life experience around seeing year over year. Hey, old tax law, new tax law, nothing's changed. How has your tax bill changed? So
right.
Yeah, there's
unfortunately, like statistics, it's lousy when you're the statistic. It may be a 1% chance, but it's lousy when you're that 1%.
Yep.
Sure.
Yep. No doubt.
Speaking of how it impacts individuals, there was something I had found on Forbes's website that I thought was pretty interesting, which was basically a Biden tax calculator. So if you really want to get a feel for what some of these proposals, how they might impact you specifically, you can actually go and probably just Google Forbes Biden tax calculator online and plug in a few inputs about your adjusted gross income, how many kids you have, and so forth, what your itemized deductions typically are, and you can get a dollar for dollar comparison as to what it would look like under current law and potentially what some of these proposed laws would do. And I plugged through in a few different scenarios, just messing with it, and the impacts were not as significant as you might think, unless once again you got into throwing in some really big numbers, big income numbers. The other thing I think is important for everybody to understand is that when is this ultimately going to take place? There's a lot of talk and debate around whether this is something that's going to not be effective until 2022 because we're still in a very fragile economy. We're still recovering from the recession associated with COVID-19. And so is it something that's going to happen maybe next year? And does that make some planning opportunities exist today in 2021? Or are they going to pass this type of legislation sooner than later and then make it retroactive back to 2021? That is up for debate.
My opinion or observation is, historically speaking, major tax law change typically doesn't become retroactive. It's usually forward-looking, unless there's extenders or certain parachutes, so to speak, depending on what the environment's like.
Right, and a lot of it deals with how quickly Congress acts on it. So if they were, starting this process today and passed legislation, say, in February, there's a larger likelihood that it would be retroactive for the entire year of 2021. If it's not until September that they start taking this up and it doesn't pass until December, most likely it'll be prospective for 2022 and not retroactive.
Right.
And I think speaking of Congress, Joe, that brings up another very important point is, you know, you're still seeing that the, Democratic Party is well short of the 60 vote supermajority that's needed for what they call cloture, a vote to end any Senate debate, on most legislation. And so, they can still do things like spending bills and pass, certain things through the reconciliation process, but to get a major piece of legislation through, it may not be as dramatic, or it may take even more time to get some of that, some of those additional votes to come together before something happens. And so that could take more time, and the more time that passes, the less likely it's going to be that it becomes retroactive. And so, that's why I think there's a lot of talk, even with the fact that, those two Georgia Senate seats ultimately went to the Democratic Party. You're still seeing that there's not a huge discussion around the fact that there's going to be this widespread legislation change, that everything's under that control. And I think that's something to keep in mind, is there's still a very big limited possibility of making some huge changes, widespread, without getting those additional votes.
Right.
One thing's for certain, there's change coming. We just don't know what exactly it is, right? Embrace
change
the change.
is the only constant.
Yeah.
There's absolutely change. And I'd say, the point of this, once again, for all that ultimately listen to it, is just to kind of, quell some of the rumors out there and some of the major fears of huge tax changes. But ultimately, guys, we're going to come back together, whether it's a couple weeks from now or a couple months from now, once this becomes a real legislation, and we're going to talk through the facts, what it really actually is, and then how it, how do we plan for it at that point. I mean, some of the things I can say right now, and I think you guys would agree, is, Roth conversions can become a much bigger thing for folks that are, in those higher $400,000 income levels or higher. Recognizing capital gains sooner than later, if you know that ultimately you're going to be impacted by that $1 million number or greater. And so, for those that fall into those categories, that's where you want to reach out to your advisor, and let's start talking, about what the plans might look like to deal with that. But once again, we'll come together when this becomes real law.
Right. And exactly, the legislative process is part of it. If you look back to the genesis of the Tax Cuts and Jobs Act, a lot of the proposals that first came out when the first House, bill went through did not become final law. And some things were very different in the final law than what were in the first proposals. And so that whole process of legislation can change the face of what the final law looks like.
Any last points to make before we wrap up?
The only thing I'll just reiterate is, obviously we talked, this is all proposed tax law, and please don't make any knee-jerk reactions because your hairdresser or whoever told you that, you heard about something that should be changed. Call us before you make any changes. Reach out to a professional. Seek guidance. Everyone's situation is different. Everyone's situation is different. Your tax return does not look like anyone else's. And oftentimes, unfortunately, people make decisions and call us afterwards, and we can't fix those decisions in retrospect. So that being said, I think we've covered it all today, guys.
Great advice, Ari. Thank you all who listened to this, and we'll talk again soon. Bye-bye now.